So, David, let's get into it. So as I was starting to say before, I don't know how much you heard. You and I have been through a lot of cycles.
I heard it all.
Yeah, okay. And so, what grabs you? What really stands out to you in terms of high conviction about what's really an opportunity, or is it just so screwed up and so uncertain? You really got to play small because we just don't know. So, like, what's really burning in your mind? What's top of mind for you? Because I look at times I shake my head. I'm sure you do. I'm like, this is not going to end well, but just keeps on going and going and going, and it's craziness. So, I don't know. What first principles do you rely upon to guide you here, or what do you think is really actionable here? So I don't know. There's some part of that, any of it, none of it. Have at it. The floor is yours, David.
Yeah, I mean, I think that it's the most important thing for somebody like me right now is not to worry too much about the day-to-day market stuff and trying to keep up with the Nasdaq or the S&P. Which that's a fool's errand. So I think if you ignore that and you start focusing on what really is going to perform well with a high degree of probability over the next 2 or 3 years, then it's kind of a process of elimination. So, for example, you look at the momentum ETF. What is it, MMUTM or something like that? I had it up here just a moment ago, but it's to me it looks like it's MTUM, the momentum ETF, and it looks to me like it's making a double top. Of course, it could break through. You never know, but I mean, it's up 35% from April 8th, so it's gone up way more than the Nasdaq. And you just look at these stocks that Carvana. There's a long list of these companies where the valuation is absolutely insane. And we were talking about Tesla. I mean, Tesla's back up to a $1 trillion valuation, and the fundamentals are the worst they've been in years. So you have this tremendous divergence, which we've always there's always divergences in the market, but I think it's probably the most acute it's ever been. And why that would be, I can't give you a great answer, because you would think with liquidity draining, which I think it has been, that some of this high momentum stuff would be under more pressure than it is. But the flip side is where there's opportunities, and I think that we talked about gold, but look at the gold miners and how much they've lagged. And when gold corrected, a lot of people were laughing at the gold miners, and they've certainly been underperformers, but you've had some great stocks within that, like AGI and AEM. But where I really like my number one commodity play, and I do think commodities are where you want to be. And Bitcoin's a different story, and I'm sure we're going to talk about that later. And I've actually started to become more optimistic about Bitcoin for kind of bizarre reasons, and just how I think it's my number one driver for Bitcoin over the next few years might be just the terrible balance sheet that the U.S. government has, and that could be a way it tries to extricate itself from that problem. But putting Bitcoin aside, my favorite play is uranium. I'm amazed at all these new positive announcements for nuclear plant restarts and how depressed uranium remains. It is perking up a little bit, but it's still extremely depressed. And the Sprott uranium ETF is trading about 10% below. Then you look at energy in general, oil and gas sector, terribly out of favor. I think you can just throw a dart at that group and make great money. I think there's a tremendous misconception fed by the IEA that there is a glut of oil, when that's not the case. So anyway, that's my quick little preamble, and I'll quit rambling.
All right, there's a tremendous amount to dig into there. So, and by the way, David, I will put up these slides you sent me as we're going along here. So I know if you want to speak to this. So, what you're talking about, David, that asset mix is about as far away from the S&P as one could possibly imagine. So again, only ask questions that one already knows the answer to. How does that speak to you? So what does it imply? What do I to infer, going the other way, your view on the S&P in particular, the big constituent parts of the index, which, the top 10 stocks make up whatever, 40% of the index. I have lost track by now. And you look at $3 trillion valuations in some of these names, they're great companies, but as we all know, there's between great companies and great stocks. So speak a little bit about the tyranny of the indices and your view on, maybe the indices don't do anything. The stocks you mentioned do really well. I mean, talk to me about the S&P, because so many people are indexed nowadays.
Oh yeah, that's the dominant trend, and we know these trends don't last forever. I don't know what's going to turn it. I would say that I kind of agree with Mike Green that what could be the turner would be a true recession, a recession that leads to a lot of layoffs, and then you would stop the flood of money into 401ks, and possibly even cause withdrawals as people get laid off. That could be what changes things, and I do think that's an appropriate point, because I think in all this tariff euphoria that we've had here recently, what's been overlooked is a U.S. economy that looks increasingly fragile. I think it was fragile before Liberation Day, and then after all that, and we still we're going to have very snarled supply chains, and businesses are in. I think they're really struggling to figure out how to cope with this environment. Do they expand? Do they contract? And so we all know that right now uncertainty is just off the charts. And I don't think that's a good thing. So just in general, there's just so much economic data that's not getting any attention because of this focus on tariffs. And I mean, just one thing, the leading economic indicators are down something like 36 out of the last 38 months. Nobody believes them anymore. I think that's what's happened. Is it's kind of like the little boy that cried wolf, is because these indicators have been flashing red for a long time, but they're getting redder. And then we've got some other negative catalysts and they're being ignored. And that's frankly when they tend to come up and bite with a vengeance. So I think that's what could be upsetting to the market over the next few months. And of the belief that this has been a very powerful bear market rally. And if you look at the activity in April, those incredible rallies that we saw in April, of course, big declines, but then these tremendous snapbacks, that's just classic bear market rally behavior. Now, if they make new highs, are we off to the races? Well, maybe, but remember that in December of 2007, the S&P made a new high. That was after all the convulsions of the summer and the mortgage disaster at that time, and Kramer screaming on CNBC the Fed didn't know what it was doing. And of course, we went into the Great Recession. So, a marginal new high, I think, should be looked at a little bit skeptically. But you were talking about the Magnificent Seven stocks. I don't think that's where the real problem is going to be. If you look at how they performed during the big sell-off, I mean, they were hit, but they weren't hit all that severely. I think the real problem is going to be, these momentum stocks that are trading at just absolutely insane valuations. Back in 2021, when I was writing my book Bubble 3.0, I was talking about the cops, the crazy overpriced stocks. Well, they're back. And in 2022, most of those went down 70 to 80%. And, they got slaughtered, and just like the momentum ETF got crushed back in April, and I think they get slaughtered again. But regardless of the timing, there's just, if you're heavily exposed to those names, I mean, congratulations, but you should at least be cashing in some of your gains and trying to rotate into things that would give you some protection in the event that things get ugly. And there are
No,
some of those.
yeah, no, I think that's a great point, about these high momentum names. It just truly has been extraordinary. I posted something a few days ago. You and I are trafficking the same stuff. There was that great thing from Goldman Sachs, which pointed out how the 1 month return, I think between high beta and low beta, or biggest garbage, lowest garbage, it was all the same flavor of vanilla. It had, I think it made like 28% in 1 month or some crazy number like that. It was so far and away the biggest 1 month outperformance of that factor, I think, in the history of accumulating the data. And as I like to joke, those are things that you don't see at a bottom. And so, I look at it and I'm just like, that's just the wrong price. And I suspect you're kind of smitten by a similar feeling, no?
It's totally the wrong price. But what I don't understand, George, is why it's continuing to go on. Because it seems to me that this is not the kind of environment that would be conducive to that, unless it's just the hallmark of a speculative blow off. And that's what people do at the end of these phases. They
Yeah,
just crowd into the stuff that's got momentum. And but to me, that just means that when it unwinds, it's going to be spectacular.
yeah, David, the last point you made, I haven't seen it recently, but I remember in the past, and you probably recall this as well. If someone goes back, one of these Ned Davis types that goes back and crunches the numbers, if you look back over the last few years, every time you've seen this type of move, I think Chanos traffics in this stuff, every time you see this type of move, it's always towards the end of an increase, not the beginning of an increase. So I couldn't agree with you more. But the question is, what makes it stop? Uh, Number go up. And this is
Mhm.
a huge, people just love momentum. It's that great Oscar Wilde quote that I keep borrowing, they know the price of everything and the value of nothing. And there was a real tongue-in-cheek tweet from the other day. I'm trying to find it, talking about how retail has won all the quote unquote smart guys, or I don't know, let's say we call them smart, let's say big guys. the big guys all lost. And I don't know if there's a sort of dystopian, uh, it's a Peter Atwater type of thing. With the same reason buy people buy shit coins and whatever. It's like, the hell with the establishment. We're gonna, David, just go back to the AMC conspiracy guys.
Yeah, no, that's exactly what I was thinking about as you were
Yeah,
talking about that. People
yeah,
were short AMC
oh
and
yeah,
into, but I mean, after they'd gone ballistic, and that's when you had guys like Mark Cuban and
yep,
cheering it on, and of course that was exactly the wrong thing to do. This was after they'd already destroyed those hedge funds, and
mm-hmm,
so it was GameStop and AMC that were the two leaders of that, and it worked spectacularly for a while, and just like what's happening now. But if you didn't get out, you just got crushed. And
yeah.
unfortunately, what happens with these, instead of people reacting rationally to these parabolic price moves, they do the wrong thing. They actually buy more, so they end up not just losing their profits; they lose real money.
Yeah, and it's almost like until, how should I put it? I don't want to say the beating shall. It's the old play on words. The beating shall continue until morale improves, or the reward should continue until numbers start going down. And then the question is, if you're waiting for momentum just to collapse upon itself, or maybe there's a macro event that comes out of left field, or maybe bond yields start really exploding to the upside. We're going to get to all this before the hour's over, but it's just in it right here, right now. It's like this is the pigs are flying. So yeah,
Well,
it's
what you're also talking about, what you're kind of touching on, but I think it's important to bring up, is because I think this has become a powerful motivator for a lot of investors, millions of younger investors, is this financial nihilism. And I think that kind of explains this, what is otherwise, irrational, inexplicable behavior.
Yeah, it just, and this is a case where uh experience would actually be a liability, because
Absolutely.
you and I are anchored by decades of seeing what happens to this merchandise before the cycle is over, and it's like you and I can't unsee what we've seen, David. That's the problem. And so it's, if you're going to get long Carvana, or if I'm going to buy Carvana, we better be joining the Chuck Prince shuffle, staying by the door. But it's just certain things I don't do. I don't do that sort of thing. That's just not my game. And I suspect that that's not your game either.
No, unfortunately, I tend to be on the short side, which is can be a hazardous thing with those things because they can go nuts. I mean, I was very fortunate with GameStop and AMC, but not so fortunate so far with Carvana. But yeah, it's just one of those times where you kind of sit back and you go,
Hey, David, Dilly, can you hear him, Dilly?
Yeah, he cut out for me.
Hey, David, did you move?
Maybe
Maybe
got a
move.
phone call.
Yeah, phone call or moved around the house. Hold on a second. Hopefully, we'll get him back. This space has been one for the ages with the technical glitches. I can't ever remember being so bad. This just got awful. So, Dilly, while we David, are you there?
"Bonds," and they're
Dave,
getting
David,
crushed.
David, hold on, David. We lost you for about 30 seconds. Did your phone ring, or did you move around the house because we couldn't hear you?
Nope,
Okay,
nope.
fine. So can you
It's
rewind? Can you just rewind 30 seconds because we didn't?
yeah, yeah. So
Yeah,
did you hear me say that I think people are missing what's happening in the bond market, not just in the
yeah.
U.S.
No,
but around the
okay,
world?
no, we missed it, but that's something we've been pounding on in this space for weeks and months. Go ahead.
But I think people aren't looking what's going on in Japan because Japan's. I mean, it's just breaking those yields are breaking to consistently new highs. This auction that happened yesterday was apparently a disaster. So you've got an incredibly steep yield curve. It's probably the steepest yield curve in the world, certainly the developed world. Why does that matter? Well, we all know that the yen carry trade has been a huge propellant of asset prices around the world. So if these Japanese interest rates are getting high enough, I mean, imagine if you're a big Japanese investor, big life insurance company, pension fund, and you're thinking, okay, well, I can buy a U.S. Treasury, long Treasury, at say, 4 or 5%. I mean, if that's the long Treasury is now breaking above 5 too, but you can get, 3% on a long JGB, and you go, well, that's 200 basis points. But then you look at the valuation difference between the U.S. dollar and the yen, and that should matter, and it does matter to these foreign investors, and you don't have that ability to hedge the currency and pick up a positive yield. It's actually negative. My point is, I think this is going to create the next leg of repatriation of capital back into Japan, which is a very big deal. But then looking at the U.S. bond market itself, which appears to be, making new highs in terms of yield. I mean, if you look at TLT, which is the long-term ETF, I mean, it broke support here last year, really long-term support last year, and then has been kind of creating some mini support around the 84 level. If that gets taken out, I think you could have a major waterfall decline in bond prices, and at some point that's going to spill over into stocks. But of course, almost nobody's looking at the bond market.
So you have a home here, David. Welcome to the Bear Den. Welcome to the Bond Bear Den. I'm totally on board with you. I don't see why any rational um, person would lend the U.S. government money at 10 years at wherever we are today, 4.5%, or 30 years at 5%, or whatever the numbers are. Um, we can talk about yield curve control, and maybe they'll change the SLR for banks and blah blah blah. But we've depressed the cost of capital globally, for all the reasons we know, for such a long time, and other valuations drive off of the risk-free asset. And there's a repricing process, obviously, because it's not just this as well as I do, if not better, David. All the capitals come here, the 20 or 25 trillion dollars that's flown here in the last decade, and now money might want to go home, and not because of the yield differentials are changing. And also there's you may not believe Europe's going to be totally successful with their release of the debt brake and all defense spending, but nevertheless there's a story there. And in China, who knows if the stimulus is going to be successful. Our good mutual friend Louis Gave has been been very bullish on China. And so there's a story to be had elsewhere. The U.S. is not the only game in town. So I want to come on to U.S. exceptionalism, David. And I don't mean it in the sense that people typically do in the financial press, where they're talking about the Mag 7 and these great companies and the innovation. Yeah, that's all true. But as you well know, there's a difference between stocks and companies. And I think where I have a bone to pick with most folks, not you, but with the mainstream media, to me, U.S. exceptional really has been the totally unprecedented fiscal irresponsibility we've had here, that we've spent money like nobody else, and because they've been willing to lend it to us, and that game may be coming to an end, and less spending, less growth. You all know public sector deficit is a private sector surplus that starts to normalize.
Well, we may not know it, but Wall Street doesn't talk about it. I mean, I
Exactly.
think that's a
Yeah, yeah,
hugely important point. I mean,
yeah,
that's everybody
yes,
wants to know why have U.S. profits been so strong? Well, it's
exactly.
partially the Mag 7, but that tremendous these tremendous deficits have been rocket fuel for corporate profits.
100%, David. So maybe just go with that a little bit further, because you and I mean, Jesus, you know what? I think if we knew how to change our voices, I think we could like pretend we're each other. We're almost like we're alter egos. But David, could you talk a little bit about the role that has played in this American exceptionalism? Because yeah, to me, it's for any other country, we get to borrow our own currency. And by the way, I can't use the Argentine example anymore because it looks like they may have gotten their act together. But you're old enough to remember when, David, Argentina would get in trouble, or we had Scandinavian banking crisis in the early '90s, this, that, whatever. Whenever you have to borrow in somebody else's currency, you get problems. Well, we've abused the privilege of being able to borrow in our own in dollars, but and I don't believe the dollar's going away. I don't think you do either. But with
No,
but the value of the dollar may change significantly. And so, could
right.
you speak a little bit about what this all means? I mean, the great talking points, but I like to drill it down to specifics. What does it mean when you talk about, you know, the dollar decline, real yields going up, and how it plays into this sort of Rube Goldberg perpetual money machine, endlessly number go up type of stock market? Liquidity, I
Well, first
guess.
of all, we know that Trump wants the dollar down, and he is for all his faults, he's pretty clever and pretty good about getting what he wants. But and I think there, like so many of the Trump objectives, there's these conflicting outcomes from wanting to, it's like trying to increase oil production 3 million barrels a day, but that just talking about it clobbers the price, which means that supply actually goes down rather than up. But trying to get the dollar down, and then what does that do to U.S. asset prices? It gets back to this thing. If you're a foreign investor and you are worried that the dollar is going to depreciate, it makes you want to come out of the country. This foreign capital flight that you touched on briefly, I think is a huge risk that's also not appreciated right now. I think we're playing a very dangerous game. In some ways, we're basically telling foreign investors go home, especially Chinese investors. Get the heck out of here. We don't want your money, and they might just take us seriously. So I think that is also a very dangerous game to play when you have, what is it? I think total financial assets held by foreign investors is around 31 trillion. That ignores real estate and direct investment into, say, companies. It's a huge number. I could be off a little bit, but it's somewhere in that vicinity. So if some of that money starts, leaving, that's a problem. And I think that's just a matter of time. And so, yeah, but one thing I do want to mention about the bond market, because we were kind of saying, well, why would you want to hold 10-year US Treasuries? Well, there's some very bright people like Danielle DiMartino Booth and David Rosenberg and Lacey Hunt who said, well, if you're going into a recession, which Dave, you just said you think there's a very good chance of that, you want to own long-term treasuries because they'll go up. And they could, I'd say briefly, but I kind of believe the Jeff Gundlach view that bond market rallies caused by recession will be like Pavlovian, a knee-jerk response, but there'll be a rally to sell into because of what that does to the issuance of debt. Which, if we have a recession, I mean, we got 6 to 7% federal deficits to GDP. What do they do in a recession? They could be 10, 11%. And you already have very weak demand, foreign demand for U.S. Treasuries. You got very weak domestic demand for long-term Treasury, as you know, where all the demand is at the short end of the curve, and that's where all the issuance is. And now there's this enormous amount of debt that has to be rolled over and refinanced at somewhere around $9 trillion this year alone, between rollovers and then the 2 to 2.5 trillion for the new deficit funding. So it's, that to me, that's what's different. I mean, everybody thinks go into recession, buy long-term treasuries. I think this time could be different. Those words are always really dangerous, of course.
David, I think again, I couldn't agree with you more, and I don't know if it's because we talk to the same people or we're
You
going.
read my newsletter, that's why. Now I know.
I read, yeah, but also, you know what? I've probably been subscribing to Charles Gav longer than you have, believe it or not.
Could
I
be.
go back to the late '80s, and
Yeah.
we go to the four quadrant model, inflationary bust, whatever, blah blah. I mean, it doesn't have to be such graphic terms, but it rhymes with what you're saying, and again, it's like, what's different this time. You use it, yeah. It's always, it rhymes, but it's always different. It's not always ever the same. And I would also, when I think about the way you're laying it out, and we're largely in agreement, you say, okay, well, where's the weak point here? Well, we know Trump likes higher markets. We know Trump wants lower interest rates, not higher. Not that he's going to get them, but and so you solve for X. You say, well, what could and we know he wants a lower dollar. So it seems to me the easiest pressure release valve is the dollar going down. I mean, if you wanted to keep, now that's going to cause problems, of course. You're a Japanese life insurance company sitting in Tokyo, and great. So you were doing this before for a big yield pickup, and now it's not such a big yield pickup. And oh, by the way, whatever the yield pickup is, you can lose that in one day, given the way the dollar yen is moving.
Exactly.
All right.
Exactly. You
So,
can
so
lose years of your yield advantage in
exactly,
just a few
exactly.
trading
So
days.
so there's no incentive at all. I mean, so that's insanity, all right? But it's the meme, David. They always talk about more, MOAR. It's like, MMT, no problem. Watch this. See, David, we spent all these trillions, nothing happened, no problem, right? It doesn't matter till it matters, all right? So what I'm kind of wondering is like we're just like begging for some big financial disequilibrium because they want to have a higher market, they want to have a stronger economy, they want to have higher profits, they want to have lower interest rates, they want to have lower inflation, they want to have a weakish dollar, whatever. That's You can have any one of those, but you can't have all of them at the same time. And
Yeah, well, that's what I was saying. That a lot of these things are cross purposes with each
correct.
other.
Well,
Just like you're
you're
saying, you
saying,
want a
yeah,
weaker dollar, but you want lower interest rates. Well,
hello,
those terms
exactly,
probably don't go together.
exactly. Oh my God. This Dave is hilarious about the space. I'm almost thinking, again, we could do role reversal. I could play you, you could play me. All right, let's keep going here. All right. So let's
The
go.
Vulcan mind meld.
Okay, so I don't know how familiar you are, Dave. You might not be, but it's okay. There's something called the nest in these spaces. If you look above your head, you might see it says shared by George Noble. And what I did is I put the tweets in there. You sent me some graphs, all right? And so
Hmm.
you may not be able to see them. So I'm just gonna read them out to you because you have them
Sure.
yourself. So the first one I'd like you to talk about. You have a graph of margin debt carried load. It shows how margin debt as a percentage of GDP with one graph and then tying to the S&P. if I look at this, it's like yelling "sell" to me with capital letters. Am I missing something here? Why did you want this graph included?
No, I don't think so. I don't think you're missing anything, but one could argue it's a small sample set. But I think the message is pretty powerful. What's different about this one? There's quite a few charts out there that show margin debt, which just pure margin debt as a percentage of GDP doesn't look too bad relative to past peaks. I mean, it's high, but it's not as high as this is. But this is making the point that if you're on margin right now, you're paying 8, 9, 10%, as opposed to 2, 3, 4, a few years ago. So the cost of carrying that is significantly higher, and obviously that matters. And if the stock market is going to have, lower returns in the future, and even this year, I mean, it's kind of flattish, which means if you're paying 8 or 9 or 10%, you're actually going backwards. And so I just think there's a potential for people to say, the heck with this, I don't want to be paying that kind of debt. I'm going to deleverage, but they'll probably be doing that at the wrong time. The right time to do it is now when prices are very frothy. And of course, I think a lot of this debt is related to those momentum names we were talking about earlier.
Right. No, I couldn't agree more. Couldn't agree more. All right, next chart, David. And again, I'm glad you only sent me a few because we don't like to do
Yeah,
that.
yeah,
But
just a few.
yeah, just a few. So one of our good mutual buddies, Jesse Felder. I
Yes,
know
see.
you've had him on multiple times. We
Hmm.
did a YouTube with him back in December, and he's big on this insider thing. So could you explain this graph? You've got economic activity versus the activity versus what corporate insiders are doing.
Yeah, the logic behind this is that insiders have a really good sense of what's happening to the economy. And just listen to Jamie Dimon and his comments yesterday, and they're he's kind of the ultimate insider, and he's I was looking for his quote here. First of all, he thinks credit is a bad risk. That should be somewhat concerning, and he sees an extraordinary amount of complacency. And I think that's where one of the bubbles right now is in complacency, which is pretty amazing after what was happening 6 weeks ago. But anyway, insiders have a pretty good sense of where the economy's headed, and based on the selling, because when they're negative, they sell a lot, and insider selling was ferocious. That did back off a bit here during the market decline, but still it's been very high, and it tends to lead the ISM composite PMI, which is one of the key economic measures, and it tracks quite well when we have recessions or major slowdowns. And so his point is it's going to come down quite a bit. But you can say, well, that's a survey thing, that's soft data, and as you're well aware, maybe not all your attendees are, is that there's this sense that the soft data has been wrong. Therefore, it will continue to be wrong. Just look at the hard data. The hard data looks great. I don't think the hard data looks great. But to be fair to the bull case, I mean, the first quarter corporate earnings were up 13%. That's pretty amazing. I think we're approaching the cliff for that. But you got to give that make that point. But again, it gets to this basic theme that I have right now, which is that I believe recession risks are underappreciated.
Right. No, that's spot on. And again, as we know, as Yogi Berra, famously once said, predictions are difficult, especially about the future. And
Exactly.
I think even more than being precise about whether we're going to have a recession or not, who the heck knows? It's what's being priced in, and are you really being compensated adequately for the idea that there could be a recession, or is it all rainbows and puppy dogs in terms of what's being discounted? All right, next one of my favorite ones. Oh my god. So
Yeah. So
no, hold on. I'm gonna trigger you first. I love we have these spaces. People are going, oh, we continue with the austerity. I'm like, continue with the austerity? Are you effing kidding me? All right, so David, for $50 in double jeopardy. Tell us about this. Tell David. Tell me more about this Doge thing and the austerity. You have the
yeah,
you have the deficit tracker chart up there, David.
Doge, we hardly knew you.
wait, wait. Doge, we hardly knew. Did you trademark that? Because we're going to steal that one. Doge, we hardly
I
knew.
didn't trademark it.
There you go. Go ahead.
No, but we went from 2 trillion to 1 trillion. Now we're 150 billion, maybe. And but then we've got this Republican tax bill, which if it goes through, and I do read David Stockman. I know he tends to be a raging bear on the federal budget situation, but can you blame him? And his point is, if that goes through, you're really looking at a $30 trillion deficit increase over the next 10 years. So an average, without compounding, of about 3 trillion a year. I don't know when. I mean, I do think the when is going to be triggered by the bond market, but at some point, this just can't continue. We're going to have the rug pulled out from under us. And I think it's going to be sooner rather than later. But people say, look, this has been going on for decades, and then Reagan proved that deficits don't matter. But realize that when Reagan came in there and started running those big deficits, the federal debt to GDP was around 30%. Now you put a one in front of it, it's 130%. That includes public and private. But come on, you got to include Social Security. I think. I mean, that's government IOUs. The government doesn't have the money for that, so throw that on the debt pile too. So it's to say that these things that you can keep growing. Now people say, well, look at Japan, which I think they're more like 250% now, but they own it all internally. They're the one of the world's largest creditor countries. I think they're still the largest. We're the world's largest debtor country. So I think the situation is radically different when you compare to Japan. But I don't know. I mean, at some point, I believe we're going to have a hell of a reckoning, but maybe it's not in my lifetime.
Yeah, and it's
Right.
and again, David, you're old enough to remember when 1986 Stein's law, and I've said this many times in this space: if something cannot go on forever, it will stop. And
Herbstein,
yeah,
not Ben Stein,
yeah,
Herbstein.
yeah, yeah, no, exactly. So who knows? Who knows? And I think the market will tell us when that is. We could already be there, okay? But it's I think it's impossible to know exactly when, but for sure. And again, things don't matter until they matter. The market has an inability usually to focus on more than one thing at a time. It's just that's the way Mr. Market is. Okay, let's go to the next graph. You've got a great chart up of consumer credit outstanding, which is now looks like it's around zero year on year. Speak to this, please. Actually,
Let me get with you. The next chart I think was looking at
oh, the yen, yeah, the
we already talked about this, so we can
yeah,
skip
we
over
just
that. But
skip
it
it. Yeah,
just shows,
yeah,
I mean, that is a pretty shocking
for
chart
sure.
when you see how much those Japanese yields have gone up
Yep.
over the last year. Okay, but yeah, consumer credit outstanding. So that you would think that if it is at a recession level, because that's kind of an important metric, that would be raising some alarm bells, but I hear almost nothing about it. Of course, what kind of the flip side, I don't think I have this. No, I don't. But if you look at credit card defaults, delinquencies, making new all-time highs, multi-year highs. So if it was a stock chart, you'd want to buy it. Same thing with auto loan delinquencies, same thing with general consumer delinquencies. So those are all going north while this is going down. I mean, this to me looks like a consumer that's really starting to retrench or having trouble servicing their debt. Of course, it's a tale of two, just like the old Dickens novel, Tale of Two Consumers. You got, the wealthy that are doing just fine, and they did just fine throughout the increased interest rate period because they're getting more interest on their savings, just like the big companies were. But for a lot of people, and kind of related to this is these companies that are more fragile, which includes, of course, a lot of small businesses, but even the publicly traded companies that are stronger, but they say they're junk credit, they termed out their debt back in 2000, but that debt's now coming due, and that debt's going to roll over at a much higher interest rate. So not only do I think you're going to have rising problems with consumer credit and loans, but also with kind of the lower grade junk. I'm not talking about double B, but let's say low single B, triple C, in that category. And I think that's Jamie Dimon's comments yesterday are very on point to that. My buddy Kevin Muir's got a really good strategy for shorting the corporate credit and isolating the interest rate aspect of it. There's an ETF that allows you to do that. If anybody wants to see that note, it's a great write-up that he just did. They can email you, and you can email me, and I'll send it to them. It's a terrific piece. But anyway, just another sign that things are worrisome. Clouds are on the horizon.
Yeah. What me worry? There you go. Alfred,
There
yeah,
you go.
Alfred,
Alfred Newman.
Alfred, you know, and please call your office exactly. All right. And then I think the last graph we had was the leading indicators. So yeah, there's this ongoing thing. The soft is this, or the soft is things going to meet the hard indicator is going to catch down. Blah blah blah. I mean, are you from Missouri on this one? Because again, there are smart people on both sides. Yeah, and I will. Actually, kind of almost in a Machiavellian way, you almost have to think that David Rosenberg and Daniel DiMartino have been so made to look so. Look, we all get it right, we all get it wrong, but this has not been their finest hour. They've been
Mm-mm.
terrorized by Mr. Market so badly that you almost think if there's any fairness in the world that their numbers should turn up now, so that the real data is going to catch down to the surveys. So I don't know. Where's your head on this?
Yeah, I think David would say that he's been the little boy crying wolf, but he would also say in the end the wolf did show up. And I followed him for a lot of years, and he does tend to be early. This probably is the earliest he's ever been. But I also think that there's some real question marks about how strong the economy really was over these last couple of years, even with all the fiscal stim. These revisions to the unemployment data have been, very large and very negative, and yet they get no press. It's kind of like with the oil market when the IEA comes out as they just did here recently, and they make another massive increase to demand for oil, particularly out of the developing world. There, and so the oversupply is much less than what they've told the world, and they do this repeatedly, and yet the revisions don't just and yet the revisions are what should get the attention because that's real. The stuff that's reported contemporaneously is invariably wrong. So I know that Danielle's very adamant that the economy, she thinks it went into recession last year, is having a bit of recovery, and she thinks it's going to double dip. We'll see, but I do think it's fair to say that if you adjust for all the fiscal stim, this has been a very unimpressive expansion, and therefore it may be more fragile when it turns down.
No, I think you're spot on. And by the way, David, if I go just a little bit further afield, I want to just veer off a little bit. And again, I'll put it up in this, but I'm telling you guys, you should, everyone in the room, and I have no commercial relationship with David, his Haymaker is just on fire. And in particular, David, one of the most impactful pieces I've read was something you put out just the other day on May 16. Our good mutual friend Grant Williams had given you access or permission to put out something from his fan de siècle, and I want to get into it was by Roger Mitchell, the indelible regression of the West. And let's not get into religion, all these existential things, but getting into the subject when you're talking about people don't pay attention to the data, like it doesn't matter. It's like the loss of, I don't know if you say integrity or truth, or everyone talks about my truth. Like people just, maybe it's just all about liquidity. Like it doesn't really matter. At the end of the day, oh David, oh George, you're irrelevant aging boomers. It's like number go up. Like they put umpteen trillions into the system. Like what did you think was going to happen? How could number not go up? And oh, you digress with all these facts. I mean, it makes me feel kind of almost irrelevant at times. Do you know what I'm talking about?
Oh, I know the feeling totally, and I think to be fair, that's the legitimate criticism. And actually, I want to give another shout out to my buddy Kevin Muir because he was the one that a couple of years ago was saying, "Hey, don't get hung up on all this stuff. Like the leading indicators. You don't understand that. This. I mean, he really was early to pick up on the fact that the deficit went from 1 trillion, I think it was fiscal 22 or 23, to 2 trillion the next year when we thought it would actually be coming down. It exploded, and that explosion of the deficit was, the liquidity floodgates opening. And it's true. That has been, I think, the number one propellant for the equity market, number one propellant for the economy. And I don't think we gave people like you and me gave it enough credit. I think we kept saying this is unsustainable. And I
100%.
think that's why it's fair to say, well, maybe you guys are wrong again. Maybe this is going to continue for years to come. And we do have the reserve currency. We can continue to take advantage of this, and I guess so. But to me, it seems like a really dangerous game to play. And frankly, I think if you believe that we're not going to have a recession, that there's still all this liquidity, and I do think that in a lot of countries around the world, there isn't going to be a recession. There could even be an acceleration, expansion. And therefore, if you want to bet that, that's where I love energy because everybody hates energy right now. I think the weighting in the S&P is something like 3%. It's very, very low. And so it's that's the way that you can make money, maybe even short term along with long term, but I could be wrong. But we've done a pretty good job actually of playing the rallies on the energy and taking profits into those rallies that have happened. And so yeah, I mean liquidity is huge, and that's why I got it to this point about we are looking at this liquidity wall. It's Michael, gosh, Every, I think is his name. No, Michael Howell. Sorry, my bad. And he is considered to be the world's expert on liquidity, and he thinks that we are in this phase where liquidity is going out the door in a big way. And I did, I did a podcast yesterday with Hugh Hendry, which was really interesting. He is absolutely a character, kind of the Rod Stewart of the financial industry in my book, but his view is that the stock market creates liquidity, and when the stock market's going up, it's almost like a self-fulfilling cycle. But to your point about Grant, and I would encourage your readers to check that out. We've been doing that as a multi-week series because Grant wrote this, or actually rebroadcast this terrific anthology from his buddies like Tony Deaton and Simon Mikhailovich, and you mentioned Roger Mitchell, and I'm forgetting some of the other guys, but it's really very good. It's very Neil Howe-like. It's very fourth turning like, but it gets into some of the, some of it's kind of philosophical, but basically the idea is that we've kind of lost our North Star in the West, and we're paying the price. And I think this financial nihilism that we've talked about, fits within that. And it's, maybe it's just kind of this last hurrah of, wild speculation before, because the end of the fourth turnings are typically really tough.
Right.
And I guess you could say maybe an example that was 1937, where you had the big bust in 1929, 1930, 32, and then you had a big market rally. Then 1937, another real tough period before that fourth turning was over. But either believe in that or you don't. I do. I think Neil Howe is brilliant. I don't know how much you guys talk about that in these forums, but if you haven't read his book, The Fourth Turning is here, I'd highly recommend it.
Great. So yeah, no, we haven't talked much about Neil Howe, but we talk all the time, and he's been in here half a dozen times. Michael Howe is a very old dear friend of mine, and so yeah. All right, so I want to bring. You've been great with your time, David. I don't want to take too much of your time, but if anyone has any questions, please raise your hand. I see we got the usual smart characters in here. David, Rusty, TX. I'm just going down the list here. Please raise your hand if you got a question for David. Hey, in the meantime, I'm going to plug the conference I'm having in a couple weeks. And David, hey, you know some of these people. So this is June 5 virtual conference, paid virtual conference in my Twitter feed. We've got Louis Gov speaking. We've got Michael Howell speaking. We have Jay Pulaski, who's big in emerging markets, formerly Morgan Stanley emerging markets guy. Ian Harnett from Absolute Strategy talking about Europe. Tavi Costa on global macro and metals. Jordy Visser, Bitcoin and AI. Mike Rothman on energy, Melody Wright on the housing debacle, John Roque on technicals, and Mark Cahodes on short ideas. Again, it's June 5, virtual 9 to 5:30. There will be replays available. So act now. All right, TX.
Impressive lineup, George. Very impressive
Yeah,
lineup.
well, it's thank you. I mean, we traffic on a lot of the same stuff, David, and I was flattered that of the I think 12 speakers I approached, 11 said yes, and one of them, shall remain nameless, but who said to me, "Gee, we thought of putting together an independent research conference for years. We never did it. Kudos to you for doing this." So I mean, to have that type of gray matter in one place at one time, I'm just like, oh my god. I've actually said to people, I don't want to be immodest, but I think this is certainly the best independent research conference ever assembled. I think it's actually the best conference period ever assembled because we're not stuck with maintenance journeyman sell side analysts. This is literally an all star team, and it's not me talking. It's all the guys who I think to be the best and the brightest. And don't worry, David. I got 11 speakers. I could have had 50 speakers. I mean, there's just so many great people out there. You mentioned some of the other names. But in any event, let's move on. So TX, welcome. You got a question for David or an observation, TX? Good to see you.
Yeah.
Go ahead.
Well, first of all, as you know, English is not my mother tongue, so I learned the expression buzz off in England. So maybe it's even worse than I thought. So
No
apologies.
worries, TX. I got it. Go on. Go on.
Okay, David, I followed you on YouTube. Everything you say, I'm 110% on the line. There is one thing that it's kind of a question. If I had told you, whatever, 2 or 3 years ago, that rates would go from essentially next to zero at the Fed fund level to 4.4 and change, and that the long end of the curve would go from three at the lowest point to five ish, or even two. I don't know what was the lowest on tens, maybe with a two
Lowest
handle.
on tens was in the summer 2020 when it was like 55 basis points,
Okay.
half
Oh,
a
all
percent
right.
basically.
Okay. I forgot. I forgot about those times. So if I told you that tens would go from 50 basis points to five, and mortgages would go from 3 to 7, uh, I mean, as far as I'm concerned, I would have told you it's going to break many things it has not broken anything. Why?
Yeah, it's a great point. I believe me, I've thought about that a lot. And I think a good microcosm of what you're talking about is the XHB, the home builder index. And look at that on a chart price chart, because what index or what sector was more impacted by that interest rate explosion that you just described than the home builders, and yet they went to a new all-time high last year. And I had been negative on them, and I basically said, when they broke out to a new all-time high, I said, you better, if you're short, you better cover,
Yeah.
or if you're long, you hang on because they're probably going to go higher, which they did. So they went and made a spike high, and then have been absolutely crushed. So I guess what you can say is that you get these situations where reality is denied and delayed, and then eventually it bites with a vengeance. And I think that could spill over to the overall market. But you're absolutely right. And I
But
will say
when you
also,
say
I'm more of a bond guy than an equity guy.
reality catches up, but forget about the reality in terms of mechanics. I mean, when the cost of debt, the cost of mortgages doubles, uh, I mean, for companies that refi and that are levered to the hill, it's gonna go from SOFR plus 400, and SOFR was zero, so now it's approaching 10% essentially. Mortgages were at three, and in spite of all that, companies are not going bankrupt, and real estate prices have gone up. So I just don't get it.
Well, I think part of it is what I said earlier, that you've had this terming out effect. So you had mortgages. I mean, almost everybody that had a functioning cortex, extended their mortgage, refied, and so the rate rise really didn't do much to them. But it didn't cause much in the way of delinquencies. But what it did was it killed affordability, and it killed new home purchases, which has been the case. And eventually, the home builders were able to dance around that for a while with all their incentives, but it did catch up with them. Then you talk about corporations; they did the same thing. That's why I brought up this point that the high quality companies went really long term with their terming out of debt back in 2020, but the junk guys, they go out 5 years. So this reckoning for them is coming up like right now. And I believe Michael Howell is all over this, and he knows way more about it than I do. So he'll be a great guy to talk to or listen to at that conference.
Okay,
So
thank
yeah,
you
I
very
think
much.
we got to remember that part of it, and also the fact that for a lot of companies, the strong companies, those higher rates were a godsend. And the higher net worth individuals was a godsend.
Oh yeah, yeah,
So it's
yeah.
there's been, and of course we had a tremendous liquidity infusion that came from other sources, whether it was the fiscal stim or the Fed doing their, they're not QE as Michael Howell calls it. So they're, it's a complex situation, and but some of these things that have delayed that impact now look to me to be running out.
Thanks for the question, TX. And before we go to
Thank you,
yeah,
thank
thanks,
you.
TX. Before we go to Rusty, hey David, I hate using these overused terms, but you want to have a similarly dim view of the U.S. Financial situation, the deficit. I mean, and just when you think there's going to be a car crash, they find a way to avoid it. But what are the odds that we avoid a Liz Truss moment, so to speak? I mean, to me, it's just I don't know. It just seems coming soon to a theater near you. Maybe it's already happening that the bond market vigilantes are calling whatever you want, like immovable force meets non-movable object or whatever. Like, I just to me, it's just. I mean, again, what you were saying earlier, to me, the most likely way that bond yields, long-term bond yields go down is for a reason you don't want, which is we go into a recession, and going into a recession may not even happen because the fiscal balance blows out. But I guess put it this way: what are the odds that no certainties in life, but if I said to you, if we're in Vegas, I sense you know something about sports. If I said to you, David, the over under on the 10 year between now and year end is 5, would you take the over or the under? Right now at 4.5 or thereabouts.
Yeah, well, as we're talking, I'm just watching what's going on with these bond yields, and they keep going higher. 457 on the 10
All
year
right,
right now,
so
over
okay,
five,
so Dave, you
breaking
just
over
so
five on
Dave,
the
so
30
Dave,
year.
you and I got a better drink, okay? Uh, at 5.5, if I spot you 5.5, would you take the under or the over? Like if I said to you, I mean, it's like David, you'll laugh. But Dilly asked ask a question about Bitcoin before the program's over. But to show you sentiment, I remember 3 years ago. This is crazy. This was in 22. I had two guys bet me when Bitcoin was at 35,000 that it would go to 100. They were right, but the only problem was it would go to 100 before the end of the year, and it was even money. Bet me a steak dinner. That's how bullish people were. Okay, so like right now, David, if I say to you, I'm willing to bet you that bond yields a 10-year goes to 5.5 between now and the end of the year. Would you even money? Would you take that bet or not? I mean, like I guess what we're really trying to do, Dave, is David.
Well, I would
Hold
say,
on,
George, I
Da-
don't think we're going to 5.5 in the 10 year. We should. I
yeah,
think we should probably be 6 or even higher. But I do think the intervention will start to kick in. And you brought up the SLR. I think that's going to be the first card they play to allow
okay,
banks to buy more treasuries without reserve requirement. I think you can make the case, well, but how far out are they going to go in the yield curve? Because they don't want to, get the same thing that happened to First Republic, Signature Bank, et cetera, Silicon Valley Bank. So, but I think they're going to play all kinds of games to prevent that. I think 5% on the 10-year treasury is a very critical level, and they're going to do everything they
okay,
can to keep it from breaking above that. So again, what it should do versus what it will
right.
do, I think are two different
Right.
things.
Okay. So we're on Jeopardy. We're on Jeopardy. So irresponsible fiscal policies for 100, David Hay. Okay. So David Hay, we're going to do SLR and all this other stuff. So bond yields may not go up as much as they should. All right, because of that. So Mr. Hay, for $50 in double Jeopardy, if that $100 in double Jeopardy, if that happens, what happens to Bitcoin and gold and the U.S. dollar in that scenario?
Well, I mean, the obvious answer, I think, is dollar down, Bitcoin and gold up. I mean, I think that's the problem. This is again where you get into these conflicting things where you try to do something and it creates the opposite of what you want to have happen. So yeah, I think that would be viewed as a very inflationary development.
Thank you, Mr. Hay. Rusty, your witness.
You quite
All
literally stole
right,
my
Rusty, fake
question.
another question. Come on, dude.
No, you really did. I was going to ask him, did you see it going to 5.5? And if so, would the Fed intervene? Um, that was
Well, that's a different question. So that's a really good question, and I've been of the belief, and I think that what Powell has been doing and saying reinforces it, is that he will not reengage in QE. Now, I'm not saying the Fed won't do QE. I just think he won't do it. I think he'll resign if Trump starts beating on him. He'll most likely say, "Tough, I'm not going to do it," because he got a year. But they'll do some other stuff. I mean, they're very, very clever. I mean, one of the, I don't even think George knows this. One of the predictions that I made back in, I don't know, 2016, 17, something like that, was that in the next crisis, the Fed was going to buy corporate bonds. And people told me I was crazy, it was illegal, and so forth. And one of the best decisions we made, and believe me, I've made some wrong ones, and I could talk about it at a different time, but in 2020, in the midst of COVID, when the Fed announced that they were going to buy corporate debt, that was our go sign to go all in on, junk bonds and MLPs and equities. And so my point is they'll do whatever they have to do to prevent a financial meltdown, and they have a lot of tools. I think that there's those of us that who've been in this is, late in the game, the fourth turning and so forth, and eighth or ninth inning, that, we tend to underestimate the power of their tools. And I think where you can take advantage of that is when you get these big sell-offs and, there's a lot of fear and negativity towards the overall setup, and then they do something and you get a huge rally. I don't think those days are over, but you don't want to be doing that when the market's very frothy like it is now. I don't think.
Yeah, no, for sure, for sure. Um, David, I think I don't want to keep much longer. You've been so generous with your time. What do you think people are not paying enough attention to that they should be paying attention to? Is it bond yields? Like, what's the people are talking about
Yeah,
black swan? Black
yeah.
swans, gray swans, white swans. Like, what is it for you? Bond yields?
Yeah, and not just like I said, not just America. I think Japan's huge because they've been the financier of a lot of these asset bubbles. So yeah, that would be certainly one of the things. But as I said, I think the economy. I'm staggered by how many things are at levels that they only hit in a recession, and some of it's now becoming the hard stuff, not just the soft stuff.
Yeah, no, it's for sure. And by the way, for everyone listening, I did put up in the nest. Rusty, I'll give you another question. 1 second before. Hold on, Rusty. I put in the nest a link to David's Substack. I really urge everyone to subscribe, and we haven't discussed this, so I got to be careful what I say. But if I knew you better, David, I'd say already you'd arrange for promo code George, where for the next week people get 50% off. But we'll talk about that later.
Oh, sure.
No, no, but
That's
no, but
fine.
seriously, hit David up, and he's an honest broker, as they say. He makes as many mistakes as we all do, but I love his thought process, and I think having some gray beards around is a good idea. Rusty, you had a follow up question for David?
Yeah, and I'm gonna just ask what your thoughts on what does Japan do at this point, right? I mean, considering they own well over half of their debt
Hmm.
themselves, right? So, what do they do? In your thoughts?
Well, they can sit on it. I don't think they're under any compulsion to, bail on that or recognize losses, and they'll just, they're very good at being stoic. But I do think they have a problem, in that their short-term interest rates are too low, and they seem very reluctant to raise short-term rates. So the bond market's doing that for them. We've seen that actually happen in America at times. So and they're worried that the economy is going to roll over there. Yet their inflation's running hotter than than certainly a 2% target would indicate, which is shocking for them. Their wage settlements have been running way over that. So yeah, I think they've got to raise rates, and what that will do is could trigger the next rally in the yen. I actually am very bullish on the yen. I have been, and it has had some great runs and taken some profits into some of those runs, but at this point it's backed off, and I think it's another good point. I think it's one of the few anti-fragile assets out there. If you're looking for a portfolio hedge, I mean, it's proven itself. Unlike Bitcoin, which I keep waiting for the time where Bitcoin goes up when the Nasdaq goes down, but that doesn't happen. But the yen has had two big rallies when you've had the market decline. So I think that kind of proves it is an anti-fragile asset. Japan, they've got challenges for sure, but they got a lot of strengths, including just this huge savings pool. And if you go over there, people have told me that it's a great country. They've got modern infrastructure, much better than ours, and prices are incredibly cheap. In fact, you mentioned Jesse Felder. He was over there and just raved about what it was like going to Japan and just how cheap everything was. I like Japanese stocks, by the way. I think Japanese stocks are, there's definitely pockets of value over there that are far better than the United States, outside of energy.
That's great. David, and then last question, are there any things that the opposite? What are people worried about that they shouldn't be so worried about? Or what do people believe that's high conviction that they really believe is true, it's going to come true, and you disagree with?
So
Yeah, go ahead.
something that they're too negative on.
No, something that they have a high degree of conviction on that you just think is incorrect. That I guess what we're really getting at is variant perception. It could be of any ilk, positive, negative. Well, where's the crowd wrong? I mean, obviously, you think they're not paying enough attention to the global rise in bond yields. We get that, all right. Um, so I'll just ask the question in a more coherent way. Are there any other strong variant perceptions that you have? Like, for instance, do you think U.S. equities are more dangerous than is commonly perceived? Like, if we go to the Michael Green, passive bid thing, like, do you think we could be in for a sustained period of time where real returns, maybe not nominal, but certainly real returns from the S&P could be negative, let's say? And that's not
Yeah,
anyone's saying.
absolutely,
That's
absolutely. I think that could happen, but I'm not sure that's a very unique comment based on what I've been talking about. It's kind of like obvious, but I guess one that might be a little less obvious that gets right to the heart of the current mania is AI. And where I think there is this disconnect, it's kind of like Trump policies, is that we can have this tremendous boom in AI without serious energy repercussions. And I think the U.S. grid, is really vulnerable.
Right. So,
So,
does that? So I agree with that, and I was going to throw out a bonus question on energy. So, but does that mean that? I mean, some of these utility stocks have gone to the moon already, yada yada. So you may say, well, it's already in the price, blah blah blah. So how do you play that in your view?
well, actually, I've got a buddy who's a very sharp hedge fund manager, and he loves Exelon, which is probably the premier nuclear utility in the country. And it's up, but it's not up a lot. It's kind of reasonably priced. I personally think the way to play it well, uranium, because I do think we're going to have a lot more nuclear power, but that's, the U.S. is so far behind. But I'm a big believer that these microreactors are going to take off. I'm a fairly significant investor in a microreactor company that is ready to start cutting metal like tomorrow if they get regulatory approval. And I think that regulatory approval process is going to get greatly sped up. So I think that could be one that comes out of the blue. Most people think that the microreactors are 5 to 7 years down the road. If it turns out they're only 1 or 2 years down the road, that could be, quite the game changer. But we desperately need something like that. I think in the interim, the solution is natural gas, and you're seeing a tremendous movement to power these AI data centers with natural gas combined cycle plants, and I think that will continue. Therefore, I'm bullish on natural gas. I like the LNG play for overseas because obviously AI is not just a U.S. phenomena. So I guess I just would say that energy is kind of a backdoor way to play the AI boom. And if we don't have enough energy or the capabilities we've got the energy obviously, but getting the energy in place in the system and protecting the grid. I mean, the grid is just, I think that's one of my biggest fears is if it goes down, either for temporary reasons or something more nefarious, like one of our geopolitical adversaries detonates a nuclear device at the right altitude. Hopefully that doesn't happen. Obviously, hopefully it doesn't happen, but it's a risk. And even a natural event, a massive solar flare, which has happened, that could take down the grid or just overloading it, as we saw here recently in Spain and Portugal.
Right. Hey,
All right,
David.
enough on that.
Yeah, that's great. David, this has been awesome. By the way, I did put in the nest the link to your Haymaker. I said I subscribe to the Haymaker. I urge you to do likewise. So I urge everyone. All right, hold on. The eminence grise of the room himself, Gnostic, has entered the stage. Stage right, David. He's to the right of you in the corner. Gnostic, as is your custom of late, since you always procrastinate coming into the room, I'm gonna have you be the last speaker. Gnostic, over to you.
Oh dear, George, you always got to throw me that ball. So, David, you're talking about the grid. Are you aware of the inverters that Trump in his last presidency, the previous one, seized at the Mexican border and then they took apart? They were Chinese coming up.
Mm-hmm. Mm-hmm.
U.S. grid. Are you aware of what they found?
Yeah, I think they found some planted stuff that.
Whoa. What? What did they, David, hold on. I hope you got the rest of the day. Now, this is getting good. Everyone in this room loves a good conspiracy theory. Go ahead,
Yeah,
David.
what?
No, I think the
David,
story
what's
just
this?
broke. The story just broke this week, right?
All right, go on. I think Gnostic's going to have to help you with this. Go on, David. Go ahead.
Yeah, it didn't just break. And George, David's going to sit down and back this up. This is not a conspiracy
All
theory.
right, well,
This
you
is
said, all right,
fact.
so stop. We're killing suspense. If I'd stop interrupting, you could word it edgewise. I said, David, what the hell happened?
He knows better than I do. I just saw a story that they have torn these, and maybe they did it before, but somehow this has resurfaced here recently. That they found that they have implanted. I don't know whether it's software, but it's basically a way that they can, uh, you know, penetrate, have surveillance on the U.S. through these inverters. But Gnostic, please, you tell me what you know much more about it than I do. I just read that article very quickly. Obviously,
Well, it's not just the inverters, but it's the transformers that go into all of the transmission lines, high power to low power, and these were massive, massive things. And so when Trump found the little nasty things that were embedded in them, he banned them from coming in under executive order. Biden then did away with that executive order and said, "Okay, no, we can bring them in." And ever since then, during the Biden administration, they have brought in thousands of them and put them into the U.S. grid. So
Not Gnostic, other than sheer stupidity, what plausible explanation as to why would they let such a thing happen? Like once they knew these things existed, like
because they're idiots, especially. But
there
your
is
point
no.
is they could shut the grid down, right? I mean, if
Yes,
they
that's the
apparently
point.
have the ability.
yeah,
Okay,
but who with half a brain would allow this to happen, Gnostic?
half a brain. Like
Sorry,
what brain?
Half
sorry.
a brain. Wait a second. It's now been shown he didn't have much of a brain left for many years.
So what do? We're lowering estimates in Biden's brain. Oh, sorry. We do not do politics in this room, David. We talk about the consequence of politics, but one of the reasons people like these spaces is because we try to keep it, on finances and it doesn't devolve into a complete food fight over this guy, that guy, but
Well,
not. Sorry, go ahead.
the issue with this one is this directly affects exactly what David was talking about: the ability to do AI, the ability to do other stuff. Basically, it brings the financial risk, the political, financial, global risk, directly into the United States grid and places it there because these pieces are placed all over North America right now. So you can't pull them out except spending years sitting down and pulling these things out and putting new ones in. And this topic just barely made the news. And if you can imagine the disruption, potential disruption for this, I bring it up in this space only because I deal with you, George. I know Dilly, David. I've seen before, other people in here. Otherwise, I wouldn't bring it up just because the potential disruption for the entire thing is unbelievable. And when David says, you need the electricity and the grid is at risk because it's shaky to begin with anyway, this is kind of, puts the on-off switch in the middle of it in the hands of foreign people. Um, and
Gnostic, how do they activate it? I mean, could they theoretically activate it in a wireless way?
I have no idea. I didn't get that far into it, and a lot of the stuff simply was not published and put out. I guess for just safety reasons, because if the Chinese can do it, then somebody else could go and find it and
All right,
try
all right,
to
all
do it
right.
as well.
It's a Gnostic. Here's the deal. We're gonna do a space next week. It's gonna be you and David co-hosting. We got to go find a guru, a furu guru expert on this stuff. This sounds pretty evil. So we got to get to the bottom of this. This is good stuff. This is good stuff. This is even better
It's
than.
really important stuff.
Yeah, this is it.
And it would be interesting to get Louis' views because he'll have a
Oh
very
yeah, yeah,
different.
yeah. This is even better than Zero Heads. This is good stuff. This is real. This is real fin porn. I love this kind of stuff. All right. Does anyone else have a question? Otherwise, David's got more between the technical
Well,
difficulties and putting up with our inane questions. He's really been a trooper. Dilly, you got anything? Or you want to close the room, Dilly?
No, thank you for your time, David. This has been great.
you're
Yeah,
welcome.
and David. I know this is going to make you even more bullish on Elon Musk, but all seriousness, I mean, you can see that when this thing works, it's actually great,
Yeah,
and
it's
but
pretty cool.
it's very cool, and this is why I should talk to you offline because I've tried some podcasts recently, but what I don't like about the podcast, you can't get the interaction from smart cookies like
Yeah, the
TX and
social
Oz.
audio.
Yeah, and also the other thing too, Dave, you can appreciate it's
Mhm.
not just the interaction. When you get a big enough room together, you can see who's in the room with you because like when you're in a podcast, it's kind of like it's a very sort of sterile, you don't know who's there. This is much more community. We know each other and it's great. So I can't thank you enough, David, seriously. And I hope we do this again at some point. And I'm not going to promise you because this app never ceases to disappoint me. But, we've had some great spaces and this is wonderful. And I hope to consider coming back again.
Great. Thank you so much, George. I would love to join you guys again. This has been a
Excellent.
lot of fun.
This has been great. Hey, thanks
Okay.
everyone. And tomorrow we've got I forget who we got. It's in my feed. All right. Good night, everyone. Take care. Bye bye. Bye.
See you
Thanks.
guys
Bye.
Bye.
tomorrow. Bye.
Bye. Bye. Bye.